Mike Wise with your weekly mortgage update. So we've had some good news for rates over the last week. The rates have continued to come down a little bit. The yield on the 10-year Treasury has actually dropped to below the 50-day moving average, which is a great sign. So next week we have the inflation numbers coming out with the CPI and the PPI, and I don't expect much of a move with those numbers. But today I'm going to focus on jobs. I have been saying this for quite some time that I think we might be at a point where the unemployment rate now may be more of an issue than inflation. So I have a few charts in my email today, and the first one explains that once we hit full employment, a recession normally follows, and you can see where I've highlighted in the yellow that was a low point for the unemployment rate, okay? And right after that are some gray vertical lines, and those are actually recessions that followed. To go a little further, there's a thing called the WARN Act. The WARN Act is an advance notice in cases of qualified plant closings and mass layoffs at larger corporations. They have to give 60-day notices to all of their employees before they have these mass layoffs and plant closings. Over the past 60 days, the WARN notices to employees has started to go up. So employers are starting to feel the pinch of the higher interest rates and are going to have to start laying off employees. In addition to that, the unemployment rate just hit 3.9%, which is up 15% from the low of 3.4%. And in the second graph in my email, it shows the history of hitting that low unemployment number and actually going up by 0.5%, by an increase of 0.5% in the unemployment rate. And when you look back, in all those cases, we go into a recession very, very quickly. Usually 1 month, it's 1 to 3 months, or 0 to 3 months, but it goes into a recession very fast. I'm not saying that we're in a recession right now, but a slowdown in the economy is definitely coming along here, and that's what the Fed has tried to do. While I'm telling you this, normally what happens when the Fed slows down the economy so much, they have to reverse course and actually lower the rate. So they've gone this far, that we've gotten to full employment. Now the Fed is slowing down the economy, and what they're going to have to do, they've put a pause on raising the interest rates, and we don't think that there's going to be any more interest rate increases, but what they've done is they slowed it down to a snail's pace, and in the second quarter, third quarter of next year, it looks like they're going to have to start to lower the Fed funds again to actually stimulate the economy and get the market going again. So what does this mean for you as far as interest rates? Well, I think that we've hit a high point and we'll start to see them go down, but they're not going to go down super fast. We think maybe, we might hit a 6% handle on the 30-year fixed rate in the first quarter of 2024, and it will go down from there even further. So this week I quoted a rate of 7.375 on a 30-year fixed rate. So that's good news, down from 7.75, 7.875 the previous week. So call me about my list and lock program where you can get rates in the 6s for properties that are being sold. So if you're listing a house and you want to sell that property, ask me about the list and lock program where you can get lower interest rates on those listings. This is Mike Wise. I hope you have a great weekend. Thanks to all those veterans who have served out there. I really appreciate what you've done. I look forward to talking to you soon. Have a great weekend.